Once again, very good morning to all. Chapter number 8. Okay, source of finance and two types of source of finance that we have learned over here. Number one, that is borrower fund and owner's fund. First of all, let me complete owner's fund. Three types of owner's fund is that. Number one, that is equity share. Second one, that is preference share. And number three, that is plug-in type of profit. After that, borrowed fund. So in borrowed fund, again, various types of borrowed fund is that. Number one, that is debenture. Second one that we have learned, that is public deposit. And right now we are going to discuss about next source of finance, which is called loan from financial institutions. So again, we can increase our capital in our business by taking loan from financial institutions. Okay, various types of financial institutions is there. Those who are providing loan to the business owner to develop their businesses. Various banks are there. Okay, various Sarafi PD, then we can use that word. Those who are provided money. Okay, let's see. Due to change in the field of science and technology, there was a rapid growth in the development of industry and commerce, so that the need of long-term finance is also increases because new technology is there, modernization is there, and for innovations of new technology, definitely we have to require more capital. Individual investors and commercial banks cannot satisfy the increased need. Therefore, need of established special financial institutions is arrived to meet large and long-term capital required for a country. Okay, so not only equity share and preference share is capable or essential to complete the need of financial management, to the need of finance of the owners, and that's why some financial owners are there, some multimillionaires is there, those who are providing finance to general public to develop their business. Okay, so here we have to learn this type of financial institutions is there and how it's provided loan. Okay, let's see. So here, with the beginning of 5-year plan in country, emphasis was laid on industrial development for satisfying long-term capital requirement of public sector, private sector, and newly established industries. Financial institutions were established by Government of India. Along with this, state finance corporations has been established to provide financial help to small and medium size of business. So here, due to industrialization, more capital is required, and for the need satisfied of more capital, some financial institutions is opened by government, and some private institutions are also there, those who are providing that particular finance. So here, various types of financial institutions is there to satisfy the long-term as well as short-term and medium-term finance to their particular owners. Some of the main financial institutions providing long-term borrowing capital are as under. So various types of financial institutions is also there. Number one, IFCI. So here various types is there. Number one, IFCI. The full form is that Industrial Finance Corporation of India. Number two, IDBI. So here IDBI. The full form of IDBI is equal to Industrial Development Bank of India. Next, ICICI. So here ICICI. So what is the full form of ICICI? Industrial Credit and Investment Corporation of India. Next, number four, GSFC. GSFC. Number four, the full form of GSFC is Gujarat State Finance Corporation. And number five, GIIC. Okay, so GIIC and full form is Gujarat Industrial Investment Corporation. So various types of institutes is that those who are providing to develop their businesses. They are providing loan. Okay, mostly we are known with IDBI because it's bank, ICICI is also bank. And that's why we understand easily that what is the work of this type of private banks. That they are provided money to general people as a loan. Okay. Next one, that is functions. So here let us discuss the function. So functions of loan from financial institutions. Okay, what are the functions? Number one, provide finance for buying share. Number one, that they are provide finance for buying share. Okay, so if you want to purchase share of any company, for that purpose, financial institutions is that those who are providing a finance to you. Okay, let's see. At the time of incorporation of company and at the time of modernization of expansion, financial institutions buy the issue of share and provide help. Moreover, they also help by offering the services of underwriter. Okay, what do you mean by underwriter? So new company is there. So when new company is there and new company start the business, at that time they have to issue share. And for the starting of a business, compulsorily they have to collect 90% share. Okay, as per the rules and regulations. So it is difficult for the new company at that time. Finance, banking, and finance institutes do the help. And rest of, for example, they are selling 80%. So 10% share that finance company is purchasing. And they are doing underwriter contract. It is called underwriter contract. And for that work, they are also charging underwriter commission. Okay, so they are providing this type of facility to the newly established business. Number two, provide finance by giving loan. Okay, so here provide finance by giving loan. So also for a new established or any types of businesses, if you want to develop the business and if you want to need of finance, financial institutions is there, those who are providing loan in form of loan, that they are providing finance. Let's see. Financial institutions give a loan to business unit against mortgage. Against of mortgage means that they have to put their assets as a mortgage. Moreover, in certain special situation, if there is a need, then over and above the assets of company, they can take mortgage of personal property also. Okay, so in short, the banking are there, the financial institutions are there. Instead of assets, fixed assets mostly, what they are doing? They are giving loan. Okay, so in this way, financial institutions also do the help to general public as well as industrial. Next, number three, help through direct payment for technological service. Okay, so help through direct payment with for technological service. Okay, so for technological services. Nowadays, that you can see, and most of the business units are taking the facility of that. Okay, that is help to direct payment. Nowadays, online trading is there. So instead of online trading, online payment is there. Net banking. Okay, then NEFT, RTGS. Okay, so in this way, what happened? That banking sectors or financial institutions, that they are provided services to industrials to make the payment of this. So this is again an important aspect or important services provided by the financial institutions. Let's see. Many times the company have to spend heavy for technological services. Financial institutions provide technical services, and so on the behalf of the company, they make the payment directly on such technological companies. So definitely banking sectors and financial institutions, that they are help to that company to make the payment directly with the help of modern services or technological services. Okay. Next, number 4, provide guarantee. Okay. So this is again most important. Provide guarantee. So when any businessman, those who are doing any transactions, so for the surety, what they are doing, they are asking for the guarantee, and at that time, financial institutions is there, those who are providing assurance to that another company in form of guarantee. Okay, by becoming a guarantor, they offer assurance to their financial institutions. This way, they offer indirect help to the companies to get finance. Indirectly, they are giving finance to the general company. Okay, and they are providing in the form of guarantee. Okay, and number 5, other services. Okay, so here other services. So instead of these 4, some other services is there. Those who are provided by financial institutions in forms of loan, that they are giving money. Financial companies offer help in establishment of company, market research, and also providing information of foreign market. And on the basis of this, any business institutions or any businessman, they can develop their business with the help of financial institutions. Okay, and these are the main financial institutions are there: IFCI, IDBI, ICICI, GSFC, and GIIC. Okay, they are providing various types of services, and a businessman can take the services of these institutions and develop their business. Next, number 2, that is commercial banks. Okay, so this is again important topic, that is commercial banks. Okay, so as we know, nowadays many commercial bank is there, provided the services, either it is the government or private banks, that also they are providing services to the general people or businessmen to giving their loan. Okay, let's see. For providing short-term working capital, the source of commercial bank is very important. Businessmen and industries depend on commercial bank for their short-term capital requirement and certain extent. Deposits accepted from the public are used by the bank for leading purpose of business unit. As we discussed in chapter number 3, remember the things. What are the main functions of bank? So number 1 function, collect fund from the market, and second functions, giving loan. Okay, so this is again the main functions of commercial bank, to giving loan to general people as per their requirement. Definitely they are charging some mortgage, they are charging interest, and that is the income of the commercial bank. Okay, so here commercial bank can giving loan to the general people for mostly short period of time. It's for short period of time. Okay, which is 1 year, 5 year. For the short period of time, the commercial banks, they are giving loans to them. Next one, leading of finance, 3 types. Number 1, that is loan. So number 1, that is loan. Number 2, that is cash credit. So here cash credit, and number 3, that is overdraft. Okay, so in 3 types, in a 3 different way that they are giving loan, they are giving finance to general people. Number 1, that is loan. This is the most popular that we are using. Okay, that is loan. I think nobody is there those who are not paying installment nowadays. Okay, because they are taking loan because of modern lifestyle. Everybody is on EMI. Okay, let's see. So here commercial bank lend money to business organization in the form of loan, which is as per the such and policy of the bank. They provide a loan after the proper evaluation of company's financial requirement, capability, and repay the money. Last year's annual account and profitability of the business. So before taking loan, before that they are giving loan, first of all what they are doing? They are checking the financial capability, whether they are ready to repay or not. If we are giving loan of 5 crore rupees to any company and there is no assets, then what happened? Installment, and we are bearing the loss. So here commercial bank, first of all, what they are doing? They are checking the financial statement, and after the checking of financial statement, that they are taking the decision whether this person or company that they are liable to pay or not, and on the basis of that they are taking loan, they are giving loan. Okay, so this is the most important things. Next, while offering loan, the assets of company is mortgage in favor of bank. Interest have to be paid, fixed rate of interest over the period of approved loan. Amount can be repaid in pre-decided installment or total at a time. So two ways that anybody can repay the money, either in form of installment or either at the end of maturity time. So this is the first one, that is loan. Number 1, 2, that is cash credit, and number 3, that is overdraft. Okay. So number 2, that is cash credit. So here, for the meeting the requirement of businessman, industrial bank approved the loan amount of loan against the security of stock, as well as personal properties. Okay, so here personal properties, on the basis of these two things, bank is given some amount of money to the businessman, that is called cash credit. Okay, approved is called cash credit. Interest on such credit facility will be charged on the basis of amount utilized and time utilized on the fund. So on the basis of amount and time that they are charging interest. So this is again second important things, that is called cash credit. And what is third? It's called overdraft. In short, we can remember that is called OD, bank OD or BOD, that is called bank overdraft. It means that excess and above of your bank balance, bank provide your money. It is called overdraft. Let's see. Bank offers the facility for withdrawal of money, more money than the balance of current account of the businessman under the certain limitations is called overdraft. First of all, bank provide overdraft to on current account. It means that those who have businessmen and those who have current account in a bank, on the basis of current account, bank provide overdraft to them. Okay, it means that on saving account it is not available generally. So on the basis of that bank overdraft, they are provided money to the businessman for develop their business. Okay, so in this three way, number 1 that is loan, number 2 cash credit, and number 3 that is bank overdraft, that they are providing loan. So two types is there in borrowed fund, again loan from financial institutions, and number 2 that is commercial bank. Thereafter again two topics is required, that is trade credit, internal corporate deposit, and difference between owner's fund as well as borrowed fund. The three topics is left, and that we will discuss in our next part. what we discuss in today's particular lecture? Number one, borrow fund from loan from financial institutions, and number two, that is for commercial bank. Okay, thank you.